It's 2:18 a.m. The house is dark. Your partner is asleep beside you. Your thumb is glowing blue from your phone screen. You told yourself you were just going to check one listing, but now you're in the Zillow vortex, scrolling, zooming, filtering. Price reduced, recently updated, good schools. You click on a house labeled charming, which is real estate language for it hasn't been touched since Clinton was president. 3 bedrooms, 1.5 baths, old cabinets, carpet that has absorbed 20 years of unknown stories. $498,000. You feel it in your stomach, that quiet pressure. You start calculating. If we put 10% down, if rates fall next year, if I get that promotion, if we just stretch a little. And here's the part nobody admits. You're not excited. You're negotiating with anxiety. You're trying to make adulthood fit into math that doesn't cooperate. Tonight, we're not talking about dreams. We're talking about arithmetic. And the arithmetic is brutal. Before we go any further, if you want brutally honest financial breakdowns that cut through hype, marketing, and social pressure, subscribe right now. Because this channel is not about what feels good. It's about what works. And what we're about to uncover might completely change how you look at buying a home in 2026.
Homeownership used to represent stability. It meant you made it. You weren't renting. You weren't transient. You owned something solid. But something changed. Quietly, gradually, and then suddenly. In 1970, median home price was roughly 2.5 times median income. That ratio allowed breathing room. Now, in many cities, that ratio sits at 6x, 7x, even 8x income. Let's be specific. Median U.S. household income, roughly $84,000. Median home in major metro areas, $450,000 to $550,000. That's nearly 6x income nationally. In high-demand areas, much worse. This is not a tough market. This is structural distortion. And yet, culturally, we still pretend this is normal. It isn't. It's unprecedented. Let's layer something else on top. Interest rates. For years, rates were historically low. 3%, 2.8%. Money was practically free. That artificially inflated purchasing power. Now, rates are significantly higher. And here's what most people don't internalize. A jump from 3% to 6.5% doesn't double your payment. It can increase it by 30 to 50%. Same house, same price, wildly different monthly burden. People anchored their expectations to low-rate reality. But the rate environment shifted. The prices didn't fully adjust. That's how you get suffocation math. Let's destroy the fantasy of the 20% down payment. On a $500,000 house, 20% equals $100,000. Median savings in America? Under $10,000. So when financial influencers casually say, just save 20%, they're speaking to a statistical minority. If you earn $84,000 and save 10% annually, which is disciplined, that's $8,400 per year. To reach $100,000, nearly 12 years. And during those 12 years, home prices likely rise, inflation erodes cash, rent increases, life happens. So most people compromise. 5% down, 10% down, which triggers PMI, private mortgage insurance, a monthly reminder that you didn't start wealthy. It's like paying a penalty for not already winning.
Let's break down the true monthly obligation of a $500,000 home in 2026 conditions. Assume 10% down. Loan, $450,000. Interest rate, realistic mid-6% range. Mortgage payment, principal and interest, approximately $2,850. Property taxes, about $500. Varies by state, often higher. Homeowner's insurance, $300 and rising rapidly in climate risk states. Maintenance, at least 1% of home value annually. That's $5,000 per year, or about $420 per month. PMI, $250 to $350. Now we're at $4,370 per month. But wait, HOA fees, landscaping, pest control, appliance replacements, that number can easily drift toward $4,800 to $5,000, and that's before lifestyle. Financial advisors recommend no more than 28% of gross income on housing. So let's reverse engineer. $4,500 per month times 12 equals $54,000 annually. Divide by 0.28. You need roughly $193,000 per year. Even using the bank's aggressive 43% DTI threshold, you'd need about $150,000. Now ask yourself, what percentage of households earn that? Roughly 10 to 20%, meaning 80+% of households cannot comfortably afford a $500K home. Yet culturally, we treat $500K as starter home territory. That's the distortion. If you appreciate this level of honesty, the kind that prioritizes your financial safety over industry optimism, subscribe, because the truth is not always comfortable, but it's powerful. Let's go deeper. Meet the Smiths. Combined income $160,000. Respectable, above median. After taxes, about $9,500 monthly take-home. Subtract $4,500 housing, $5,000 left. Cars, $800. Insurance, $250. Fuel, $300. Student loans, $600. Healthcare, $400. Groceries, $900. Utilities plus internet, $450. Remaining, roughly $1,300 to $1,500. That's their margin. Now imagine a $6,000 roof repair, a $4,000 medical deductible, a layoff lasting 3 months. Their lifestyle looks affluent. Their margin says fragile. This is the modern paradox: high income, high liability, low resilience. Now here's something critical. Nobody in the home transaction ecosystem benefits you from buying left house. Not the bank, not the agent, not the seller, not the builder. Every participant profits from maximization, so the system nudges you upward. Just a little more. Stretch slightly. You'll grow into it. But financial stress doesn't wait for growth. It compounds immediately. Now let's talk about what nobody calculates. What if instead of $4,500 per month, you capped housing at $2,800? That's $1,700 difference monthly. Invest the $1,700 per month at 7% annually for 25 years. That's roughly $1.3 million. The difference between stretching and restraining could be 7 figures. Not because you bought, but because you overbought. Social comparison drives housing decisions. You see peers upgrading. You see Instagram kitchens. You see backyard fire pits. You don't see their anxiety. You don't see their spreadsheets. You don't see the silent panic at month end. We finance appearances, then quietly absorb the stress. The system changed. Asset prices detached from wage growth. Interest rates reset. Cultural expectations didn't adjust. And you're standing in the middle of that mismatch, wondering why it feels suffocating. It's not your character, it's the structure. Real wealth is not a large mortgage, it's flexibility. It's the ability to leave a toxic job, start something new, sleep at night, absorb shocks. If $500,000 works for you comfortably, fantastic. But if it only works because the bank says it qualifies, that's not comfort, that's leverage. And leverage without margin is stress. Before we wrap this up, let's take a moment to zoom out and look at what's happening in 3 of the most discussed housing markets in the world: the United States, United Kingdom, and Canada. Because if you think the $500,000 trap is bad in the US, wait till you see it from a global lens. United States, the American pressure machine. Home price to income ratio. 1970s, 2.5 times median income. 2026, major metro average, 6 times to 8 times. Median household income, $84,000. Median home price, $450,000 to $550,000 plus. Mortgage payment 10% down, $4,370 plus monthly. Income needed for comfort, $187,000 plus annual. What does that tell us? Most Americans are priced out of the starter home dream. Whether measured by debt to income, down payment hurdles, or monthly cash flow, the math no longer makes room for the average family. This is what we've been describing, and it's not theoretical, it's structural. United Kingdom, a smaller market, bigger squeeze. The UK has an even steeper housing sickness. Median price to income ratio in UK, 8 to 10 times income. In London and the Southeast, often above 10 times. Median UK household income, £32,000, about 40,000 USD. Median UK home price, £260,000, about 225,000 USD. On face value, UK home prices are lower in currency terms than the US, but because incomes are lower and ratios are higher, the burden feels heavier. Renters say they're saving for a house. First-time buyers say they're priced out, and analysts openly wonder whether millennials will ever buy at all. Down payment at 10%, £26,000. Median savings, far below that for most households. And interest rates, higher and stickier than in recent US cycles. So a family earning 30 to 35K often finds themselves in a tougher position than an American earning 60 to 70K. The numbers are telling the same story as here. Housing is no longer a pathway to stability, it's a barrier to it. Canada, a housing market on fire. Canada's numbers are among the most extreme. In Vancouver, home price to income ratios can exceed 12 times. In Toronto, many neighborhoods hover around 10 times. Median Canadian household income, 75,000 CAD, about 55,000 USD. Median home price, 720,000 CAD, about 530,000 USD. Again, the ratio is staggering. Canada's market has been fueled by low rates, foreign capital, land scarcity in major cities, and investment demand. The result? Massive price inflation not matched by income growth. Unlike the US, where prices vary wildly by metro versus rural, Canadian markets are uniformly high. Renters in major Canadian cities often out-earn and out-save American renters and still can't buy a basic home without extending well above safe debt limits. Here's the key takeaway, and this is where your brain needs to shift from local anxiety to systemic understanding. All three countries, the US, Canada, and the UK, are experiencing the same structural disconnect. Asset inflation rising faster than income growth. That's not a coincidence. It's monetary policy effects, global capital flows, demographic pressure, low rates fueling speculative demand, a feedback loop between wealth and housing. In all three markets, the traditional path toward financial security, buy a house, build equity, grow free cash flow, is becoming harder to rationalize. You don't see this on TikTok. You don't hear it at the dinner table. But the math doesn't lie. Even if the numbers are denominated in different currencies or climates, the pattern is the same. Housing is no longer the predictable foundation of wealth it once was. It's a lever, a gamble, a bet on future price appreciation, not a guarantee of stability. If you combine US ratios that are already high, UK ratios that are historically extreme, and Canadian ratios that barely make sense, you start seeing a global pattern. Major housing markets have detached from local earnings power. And because housing is the largest household asset in most financial plans, that detachment becomes not just a financial crisis, a structural financial crisis with ripple effects. Jobs, migration, retirement security, family formation, consumer confidence, it's all connected. Owning a home should not feel like emotional Russian roulette. Your retirement shouldn't depend on interest rates stabilizing. Your kids shouldn't have to abandon cities to find affordability. But these are the constraints now. And here's the rebel position. You don't have to play the game the way the system designed it. You can choose practical affordability over aspirational leverage, options and flexibility over rigid mortgage chains, financial freedom over social pressure, margin and optionality over life-consuming payments. Because here's the truth. Normal is expensive. Average expectation is unstable. And the real money is built in disciplined restraint, not in buying the most expensive front door possible. If you're still watching this, if your brain is buzzing with all this math, all these numbers, and all these patterns, you're here because you want clarity, not hype, not surface-level motivation, real understanding. Subscribe to Darek Invests now. Because most people react to financial pressure, but winners anticipate it. Don't just survive the system, understand it, outposition it, win inside it. I'll see you in the next one.